Welcome to Everyday Investor. I'm Nicole Edmonds, filling in today for Toor. Today we're going to be learning how we can make money investing in multifamily residential across North America. Grab your pen and paper and don't go anywhere. Everyday Investor begins in a moment. On this episode, we learned from Crombeen how our money can make us money investing in multifamily residential across North America.
Obviously, you have questions to ask if it's a very, very high turnover rate. Why is there that high of turnover? Again, is it students that are coming in and out? Is it different employment bases that have had turnovers? So again, there's a lot of diligence that goes into it rather than just looking at the number and saying this is the range of what we want.
Everyday Investor is brought to you by ProFunds Mortgages, Fixed Returns, Real Security, Clover Properties Rent to Own, Invest with a Purpose, Sam McDaddy Real Estate, full service brokerage for all your buying, selling, and investing needs. Welcome back to Everyday Investor. I'm Nicole Edmonds, filling in today for Toor. Today we're going to learn about how we can make money investing in multifamily residential across North America. Remember, before you get involved in any investment vehicle, you always want to ask 4 questions. 1, what is my return on investment? 2, when do I get that return along with the money I put in? 3, what is the minimum cash amount needed? And 4, what is the risk in the worst case scenario? Today we have Crombeen with us today to teach us how we're going to make money investing across North America in multifamily residential. Brandon, thanks for coming on the show.
Thanks for having me.
So Brandon, we're going to get into talking about some land development strategies and development of existing rental properties. But what I really want to know is how does a guy go from being a professional athlete to a professional in the real estate world?
Yeah, so it's I guess a bit of an interesting story, but really started working on my degree while I was playing hockey. Had some very good support and family around me that encouraged me to do so. As I was doing that, kind of started looking at what careers were interesting as a post-hockey career. Got introduced to the people at Greybrook, where I now work, and really fell in love with it and have been at it ever since.
Cool. And so you're an investor yourself, I would imagine?
I am, yes.
Yeah. And something I really like about Greybrook is it offers these very passive investment opportunities to investors who then want to spend their time, with their family or doing other things that they're passionate about. Is that something that was appealing to you when you started to become an investor?
Yeah, truthfully, I didn't really think of it from that angle. I was just very interested in it. But I think obviously as I've grown older, I've got 3 young kids, and trying to spend as much time as I can with them and all their different activities. It's obviously become more and more a priority and a focus for me, and something that we obviously try to give all of our investors. The ability to passively invest alongside us and our partners, get exposure to some great assets, great opportunities, but not have the day-to-day headache of managing it.
Okay, so today we're going to talk about investing in multifamily residential. I know at Greybrook there's kind of 2 strategies, is that right? Some land development, and also now newer is investing in multifamily residential. Can you talk a little bit about those 2?
Yeah, so really again, our history's really been in various different funnels within the land development. So land development, high rise, low rise, different types of low rise, whether it's small infill townhouses or large master plan communities. About 12 to 18 months ago, we really started looking quite actively in the multifamily value add. So looking to acquire apartment buildings that we saw the opportunity to add value and create value, through a strategic plan on the asset. So that's something that again we really looked at for about 12 to 18 months before we actually started acquiring properties. Obviously did a lot of research, worked alongside our partner who was active in it, watched them go through various different investments that they were in, how they were having success in that, had some exits, etc. And then obviously within the last 12 months we've acquired quite a few number of units across many different geographic locations in North America.
Okay, so you guys were looking at how a developer was doing this and looking at their numbers before diving in. And so now are you guys doing it on your own, or are you doing it with those developers?
We're doing it with one development partner. Again, they have a long-standing history in the space through kind of their family lineage. They were doing this themselves for a few years, and again, we watched that closely. Again, wanted to see their execution, see the properties they were working on, and really follow that closely before we were investing in it and bringing our investors alongside in it.
That's smart. So when we're talking about adding value in it through strategic, what are we talking about? Are we doing renovations to the properties? What are we doing?
Really kind of the two key features are again, renovations to obviously look to grow the net operating income by way of increasing rents. The other side of it is really management of the property, of expenses, looking at different synergies if you're acquiring a portfolio of assets that, again, if you can look at that and save yourself 1 or 2% on expense costs, on the other side of it, you're spending money, but you're also increasing the operating income, which obviously increases the value of the asset. You do that over a number of units within a greater portfolio, and obviously there can be a pretty significant gain in the value of the asset.
That's interesting. So you guys are not only looking at an increase in value from renovations, also decreasing expenses, and by doing those renovations, you're able to then increase rents. Is that the idea?
Yeah, exactly. So again, obviously, people are usually looking at multiple products when they're looking to get an apartment. So obviously looking at what comparable product is, what rents they're getting, really running our pro formas off that. Obviously, a big portion of what we're looking at is the turnover ratio. How often are people moving out that we're going to have the ability to increase those rents? Again, it can change quite significantly from one market to the other if there's rent controls or different parameters around how you can raise someone's rent. That obviously is a big part of the diligence we're doing when we're looking at these assets. So really at the end of the day, what we're looking at is ensuring that we have the ability to increase that net operating income, which all of these would trade off a cap rate based off what their net operating income is. So obviously the greater the net operating income, the greater the value of the asset.
The value of the property, that makes sense. So when you're looking at these properties and looking at the areas, or looking at what the rate of tenant turnover is, I would imagine that you almost want high tenant turnover to get in and renovate, but you also want high demand. So what are you actually looking for?
It's a very fine balance. I mean, I think, it's obviously you have questions to ask if it's a very, very high turnover rate. Why is there that high of turnover? Again, is it students that are coming in and out? Is it different employment bases that have had turnovers? So again, there's a lot of diligence that goes into it rather than just looking at the number and saying this is the range of what we want. And again, it varies greatly from, city to city. As a simple example, in Toronto, obviously, you don't have the ability to go and say, your rent next year is going to double. As a simple example.
Or kick somebody out,
exactly.
We're going to renovate your unit.
Exactly. So in certain markets, you do have that ability. Again, whether you want to do that is a whole different argument or thought process. But again, really, that's what we're looking at is kind of all those factors and making the decisions of saying, do we think there's enough turnover ratio that it's going to allow us to go in and do what we want to do? And is there also the demand for this product? Again, and that's kind of digging even deeper into it. We look very deeply at the supply in the market, the demand, what's planned for development, how our product compares against those type of products, et cetera.
I imagine you have a huge team doing that, because that sounds like a ton of work.
Yeah, exactly. Yeah. There's a lot of work and a lot of very smart people involved with it.
Yeah. Okay. And so, what kinds of properties are these? How many units is a typical building? Are they big units, small units, and big buildings, small buildings?
Yeah. So I think we're probably targeting somewhere in each asset that we're acquiring somewhere between kind of the 300 and 500-600 units in terms of total size. Again,
like the one building would have that many units?
So yeah, to give an example, we acquired 11 buildings in Montreal and Quebec City as one portfolio that was a total of over 600 units.
Wow.
So when we're looking at that, there's some buildings in there that have 15 units, but in the greater portfolio is obviously where we see the efficiency.
Wow. Okay. And so walk me through being an investor, a developer. How are we all partnering together? What are we doing? How does that work?
So really, on day one, we're doing obviously all of our diligence beforehand, before we're going out and raising capital.
You, Greybrook.
Greybrook, alongside our development partner. Do all of our diligence, our underwriting, determine if we think there's the opportunity in the asset, secure the actual purchase. We would then go out and raise capital. Obviously, investors would come in at that point. and really we are taking it through the full management. So again, there's kind of a multitude of people doing different things in the process, from management to determining what we think we can push rents to, what does that cost us, what's the process to do that, what type of finishes do we want to put in, is it amenity spaces, is it just in unit, all these different factors that we would look at. We obviously then report back to investors as to how the process is going, how many units have turned, what rents we're achieving, et cetera, et cetera. And really when we're going into these, we kind of have a defined exit plan that we're looking at and saying, in 4 or 5 years, we think we'll have turned over enough product, our net operating income will have grown from X to Y, at which point we're going to look to exit and sell.
See enough profit to exit and pay out the investors at that point. That's exactly it. Okay, very interesting. When we come back, I want to hear what the returns are and what the returns are that an investor can expect. But we're going to take a quick break. When we come back, more on investing in multi-unit residential across North America. Everyday Investor is brought to you by ProFunds Mortgages, fixed returns, real security. Clover Properties Rent to Own, invest with a purpose. Sam McDaddy Real Estate, full service brokerage for all your buying, selling, and investing needs. Welcome back to Everyday Investor. We've been talking to Brandon Crombeen about investing in multifamily residential across North America. Brandon, so we've been talking about how investors, we can get in with pre-existing buildings, right? Renovate them and then sell them. And so what kinds of returns can we expect as investors getting involved in these deals?
So in our value add portfolio, we really target somewhere between a 14 and 18% annualized return.
Okay.
Depending on where we're buying the asset, how we're acquiring it, the current cash flow, et cetera, et cetera. From time to time, we do have some that pay current cash flow. So as a simple example, we had an asset that we acquired in Houston. It started paying about 3.5% current. As we go through and obviously grow that net operating income, increase rents, had the efficiencies to the expenses, et cetera, it will grow, and over a 5-year term is expected to blend to about a 7% average yield.
Okay, so when we're saying annualized, we're taking the return at the end, dividing it out over the entire term of the project.
Yeah.
So overall, we're saying 14 to 15%?
14 to 18 is kind of our typical target on these assets.
Yeah.
In some, you'll have a current yield. So again, in the Houston,
cash flow.
Exactly. So you'd be getting quarterly distributions of, again, in that example, you'd be getting 7% per annum over the term. And then at completion, you would get your return of invested capital as well as your remaining profit.
From that sale, from that equity boost from the sale. Okay. What kinds of renovations are you guys doing to get in and really see that value shoot up and be able to increase your rents? Yeah,
so it's really asset specific. There's examples where we're simply going in and putting new laminate flooring down, new kitchen cabinets, painting, really kind of a very simple renovation. There's other examples where we're redoing hallways, elevator shafts, doing a full gut of the unit. Really is dependent on the existing condition of the asset that we're acquiring, B, where we think the potential for rent movement is, because really it's kind of a simple question of, do the numbers add up? So if it's going to cost us $10,000 a unit, what are we going to get in terms of increase in NOI? If it's going to cost us $25,000 or $30,000 per unit, we're obviously going to have to see a much bigger jump in terms of the value on the NOI.
Yeah, so what are you targeting when it comes to that? How much you're going to have to put in? How much do you want to see in rent increase? So
again, it really goes back to the dollars that you're putting in. And to give a very simple example, in our site down in Houston, we would simply look at it and, ballpark number, we would be spending $10,000 per unit. Structurally, it was in very good condition. There wasn't a lot of, major work to be done outside of the interior of the unit. So they were just simply dated units. So going in and putting new flooring, new kitchen cabinets, new countertops, new appliances, et cetera, it would cost us just under $10,000 per unit. We were looking at $100 to $125 in monthly rent increases on that. Okay. So really, when we look at that, obviously, it's a balancing act of numbers, but, somebody might ask, well, why are you going to invest $10,000 to get $100 a month? That's only $1,200 a year. Really, when we look at it, we're looking at it and somebody's buying the asset based off the net operating income, looking at that and saying, okay, well, what am I willing to pay on a cap rate? And that's really how these assets trade. So simple example where we've increased the rent by $100 a month, that's $1,200 a year. Multiply that by a 5% cap rate, you've created $24,000 in value to the asset.
Okay, so that's where it's making sense.
Exactly.
You're putting in $10K to renovate this unit,
Yep.
but you're actually seeing $24K
in value.
Yes. From that one unit. And you said you're doing these on huge buildings.
Exactly. So when we're looking at something that maybe has 500 or 600 units, again, we're obviously not going to get to every unit, but if we did 200 or 300 of the units, obviously there's quite significant value created by doing it that way.
Yeah, and I'm sure that's where it really comes into play how important it is to have an experienced team deciding where we're going to put our money into these units, because I think a lot of investors who are starting out and renovating a unit might dump a whole bunch of money into something that they're not going to see that return on.
Absolutely.
So if you're just going through and putting $10K in, which is not a ton of money to renovate a unit, but really seeing that increase. Imagine.
Yeah, I mean, it really is a bit of a science. When we're looking at assessing these things, again, it could be something as simple as the Nest thermostats, or it could be putting in a fence on the ground floor unit so somebody could have a dog and have a space to let them out and run. And you see pretty significant jumps in prices for what somebody's willing to pay for rentals.
When we work out the numbers, it seems like it's a brilliant plan to put in that amount of money and increase the value by that much. But when you're buying these, somebody already owns them. So who owns them, and why aren't they doing it? What are you finding when it comes?
So really there's, obviously a long list of different people. I would kind of bucket it into two. There's institutions, whether it's REITs or pension funds, et cetera, that have held these assets for a long time. Or two, you have kind of the wealthy individuals that, again, whether it's passed down from generation to generation, that have held these assets and look to do that. Again, really, two different answers to the question. One, in certain instances, an institution or somebody even that knows and understands the value add space may be looking at it and say, I'm not buying this asset to deploy further capital in. This is an asset that I'm holding and collecting cash flow on.
Yeah.
I'll leave that for somebody else. And then option two really is a lot of times individual owners don't think of it that way. They look at it and say, I'm collecting money. Why would I put money back into this? Again, from a very simple example, if somebody had a building that they had $1 million of net operating income, and they're taking that and living off that money and using that money for whatever they please, for them to say, well, for the next 5 years, I'm only going to take $100,000 out and
dump
all that
this
money back in. Really, it oftentimes is hard for them to see that and look at it from that angle and say, well, I'm going to create total value. And again, really the last part of that, especially in Canada, a lot of these assets don't trade hands. So they've been in families for a very, very significant amount of time. There's tax consequences, though many times they've depreciated the asset to zero. There's significant tax consequences if they're going to sell. So they're really not looking to increase the total value. They're looking to get their cash flow out currently.
And so then you guys are buying, you said it's maybe 3 to 5 years typically?
Yeah, it really, again, depends on the size of the asset and the turnover ratio. So again, if we see a very low turnover ratio, it's obviously something that's going to take more time to turn a portion that you would want to do.
To get access and do the renovation.
But really, we are targeting that 3 to 5 year hold period.
And then who are you selling to at that point?
Yeah, so again, very good question. And really what we're looking at and why we typically don't renovate all of the units. So again, depending on the size and scale, we're typically looking to renovate and essentially prove out the model from anywhere from 50 to 70% of the units. So again, you then kind of leave the door open for another value add investor to come in and say, there's still meat left on the bone, so to speak. Or you have large institutions, pensions funds, individuals, et cetera, that are looking for a constant cash flow
to just
stream.
Operate it as is.
Exactly.
Okay.
Exactly.
So you kind of have two different groups that you could target then for the sale. Okay, and so from an investor point of view, I mean, it sounds like there's a lot of work that goes into these, right? As an investor, would I be, making decisions on those things? Am I kept out of that?
Yeah.
How does that work?
So really the way we're structured and set up is obviously we've built a team of very good professionals to manage these assets, make these decisions. So we're not giving the investors any decision-making ability on the day-to-day and what paint color we're using or how we're finishing these units, but we do want to keep them very informed. So again, we send out semi-annual reports, again, updating, giving examples of units that we've turned over, the work we've done, what the actual cost is, what our growth and the net operating income is, et cetera, et cetera. We send those out twice a year. Again, we really try to pride ourselves on that. Anytime there's a question or you are curious of what's happening, you can give us a call, and we're always happy to discuss what's happening with the asset.
Well, we've almost run out of time, but I just want to ask you as well, Brandon, if an investor does want to be involved, do they need to put in cash, and or is it a registered fund eligible, and what are the amounts? What's the minimum amount?
Yeah, so our minimum investment is $25,000, and people can invest either cash or through registered funds. So RSPs, TFSAs.
Okay.
Obviously, from a cash perspective, whether it's personal or corporate dollars, obviously there's a qualification process to go through, but getting through that's a fairly straight line process, and then obviously investors can choose how to invest in different offerings.
So they can decide a specific project versus having their money and everything?
Yeah, so we're structured that it's not a fund. You're not investing into everything we own. You're investing into a specific asset. Obviously, we preach and hope investors diversify over a multitude of projects and different types of properties and development partners, et cetera. But really, we're trying to encourage that and then letting them decide where they want to deploy their capital.
Yeah, especially if they're making returns like that. I think a lot of people aren't making that kind of money in their RSPs or TFSAs.
Exactly.
So it's definitely a very appealing option. Well, time flies, Brandon. So we've run out of time, but thank you so much for coming on the show and educating us on how to make money investing in these large-scale multifamily properties across North America.
Thanks for having me.
And thank you to our audience. Whether you're watching on TV, online, or listening to the podcast, thanks very much for tuning in. To learn more about this show or any other episode, or to become an Everyday Investor Insider, visit our website at everydayinvestor.com for exclusive investment opportunities, tips, and advice. We'll see you next week, same place, same time. Thanks very much.